Deposit insurance is no protection against bail-in risk. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
Here we are, part 2 of our series.
So today we're going to take the conversation forward because this series is really about bail-in, but I wanted to obviously talk about deposit insurance because there's still a lot of confusion about deposit insurance. What is it? How it actually interacts with bail-in. And these are a common set of points of confusion that I picked up in 2019. So I thought it'd be we have some new information to reveal about bail-in in part 3, which is quite bombshell. But before we get to that point, it's actually important that we take our viewers along the journey to explain how all these components sort of mix in with each other. So obviously the reason why I asked you to replay part 1, which was the discussion about deposit insurance, is a lot of people still don't understand fully about what is the $250,000 deposit insurance guarantee. And what are the limitations around that? So hopefully that show explained in terms of the fact that the government has set aside no money to pay the insurance, and this is a criticism by the IMF. The amount of insurance per institution hasn't changed in over 12 years, so it's likely that, particularly with the big 4 banks, there's a significant issue of underinsurance. So even if they got the full insurance amount, maybe not all deposits would be covered under that prospect. So that's an added risk that customers would have to consider. So, but today is, I think, an important piece in the conversation about, people think that if they have $250,000 in an institution, where they are sort of covered and they are protected. And what we wanted to sort of talk about in this show is to dispel this myth that, I know some people who have like $1 million, $2 million, and they've said, well, I've spread my money, $250,000 across like 4 banks, 6 banks, 8 banks. And by doing that, I'm protected because of the guarantee. Well, to the purpose of today's show is to say that if this is a strategy you are deploying, you are not protected because you have misunderstood the issue of the bail-in risk and how that actually interacts and intercedes with deposit insurance if it is actually activated, which we sort of covered in part 1.
Yeah, and I think we should just say that there is some sense in spreading the risks across the 250, right? Because that's still working with the scheme. But the scheme's not activated.
Correct.
First point. And then the second point, and it's the one that I keep getting more emails about than anything else, is how does bail-in and the deposit scheme interact? Because it could well be that they decide to trigger a bail-in relative to triggering the deposit insurance scheme.
Yes.
And that's the dilemma that we face.
Indeed. Now, about 6 months ago, I wrote a couple of pieces on my website about the topic we're writing today and about what we're going to discuss in part 3. So let's actually we're going to put a link in the YouTube comments. So let's actually put an image on the screen just so people can have a look at what the article looks like if people want to read my analysis in more detail. But basically, before we actually get into this interaction of how deposit insurance works with bail-in risk, I think there's a couple of important points to make about bail-in, just so we're crystal clear with the audience. So the first point is to say is we, in terms of you and I, and the shows that we've done since 2018, we have never said that bail-in was automatically going to happen. Now, there are other groups saying that, other groups in Australia saying that no, bail-in is definitely going to happen. What we have said is that the government says that the risk of bail-in of retail deposits is 0. And our proposition is that we don't accept that proposition. So, we think bail-in is possible, but we're not saying that bail-in is automatically going to happen.
Yeah, and it's very muddy in Australia, as we've said several times. If you compare Australia with New Zealand, in New Zealand it's really, really clear, very transparent about how they would do bail-in, and it's clear that it's articulated by the Reserve Bank in New Zealand. We don't have the same here in Australia, but there is some legislation which could be purposed for that reason. And because it's unclear, people need to actually read the tea leaves a little bit harder, I think.
Exactly. Now, what the government has admitted to is that with the Financial Sector Legislation Amendment, Crisis Resolution Powers and Other Measures Act 2018, they have said that what can be bailed in is what they call hybrid instruments, hybrid securities, basically financial instruments where there are express terms that are said in the prospectus documents, etc., that this instrument can be bailed in. So this is what they've admitted to, but they've said retail deposits are exempt. Now, what we showed in our 2018 five-part series was that under the legislation, if an instrument, if an instrument could be bailed in, it must have express language to say that it can be bailed in. When we said those, when we sort of did those shows in 2018, what we showed was that at that point, the terms and conditions of retail deposit accounts did not have any express terms to say that this retail deposit account can be bailed in or could be converted into equity or whatever the case may be. But the ability of the banks to change these terms and conditions without telling customers, the banks had enormous flexibility, and they still have enormous flexibility in terms of their ability to change these T's and C's whenever they wish, with basically no prior warning. And our view was that in the midst of a systemic financial crisis, the banks could overnight change their terms and conditions to be in line with the legislation in terms of the requirements. And then once that step is done, then APRA could issue a recapitalisation directive to say to the banks, you will bail in these types of bank accounts, deposit accounts, whatever the case may be. So that's the step process at which we have said. And again, what we're going to show in this show is that even though that there is a loophole, and we did a show in 2019 that we'll put up on the screen, where we actually had an independent lawyer go over our analysis and basically agreed that yes, there is a loophole, and the loophole we identified is actually correct. The banks can change the terms and conditions of retail deposit accounts, and that is the sufficient step to be compliant with the legislation. Therefore, bail-in can happen with the order of APRA. Now, a couple of points is APRA has never admitted to this loophole. And there's probably a bit of a question as to whether the government actually acknowledges or even understands that there is a loophole, but there is definitely a loophole of how they can, make bail-in of retail deposit accounts work. And and I should say that there are people in Parliament who are opposed to bail-in of retail deposit accounts and who were initially sceptical of our shows in 2018, but once they saw our work and thought about it, they've come around to the view that no, there is a loophole. But having said that, even though there is a loophole, Parliament has still done nothing to address the loophole.
And just to go back, when the legislation came in, there was an attempt to try and exclude deposits specifically from the legislation at that time. And basically, that was sidelined due to some shenanigans in the Senate.
Correct. Yep. So there was an attempt to make it crystal clear retail deposit accounts are off the table, and the government didn't want to play ball with any of those type of amendments. Now, the other key point about last year was we did a show back in March of 2019 called "It's Too Late, Bail-in Has Already Happened," and that show was important because one of the consistent narratives we have heard is bail-in can never happen in Australia. Well, bail-in has already happened in Australia. It happened in 1892 and 1893 in Melbourne in particular, in that depression. Now that was called Reconstruction, but basically, and people should go back and have a look at that show. But basically, what would happen is a bank got in trouble. They collapsed that bank, created a new bank, and then took deposits from the old bank to actually give the new bank capital in order to function. So the conversion of deposits into shares into the new bank, that was Reconstruction. That is bail-in. The conversion of deposits into shares, just like what happened with Cyprus in 2012, 2013. It definitely happened in Melbourne in 1892 and in 1893. And just to highlight this for the audience. I still remember one of the comments you said to me last year that you thought that the Cyprus episode was the first experience of bail-in in human history, and yet Australia could have actually invented the whole practice more than a century ago.
Yeah, well, we often are innovators, even if it's not necessarily things we want to be remembered for. And I think it's just worth highlighting that the whole concept here is that, as you say, deposits, which are being redefined as effectively unsecured loans to the bank, right, are then converted into capital in the bank.
Yes.
But of course, as a holder of capital in the bank, you don't know what the value of that capital is, and you are basically being given to take the risks of the future of the bank. Whereas if you're holding deposits, then you don't have the same degree of risk.
Of course. And just to add to that point, so when they did bail-in 1892, 1893, so basically their deposits got converted into shares, those new banks failed. So you still lost your money anyway. Whereas in the case of the Bank of Cyprus, that is still an ongoing concern. Yes. So the Cyprians can say, well, our shares, whatever they're worth, we still have something, compared to nothing, which was in terms of the Melbourne experience.
Yep.
So that's important, because anyone who says this is conspiracy or this can never happen, it's already happened. Number one. The other point I just want to make on this is that just to go back to our show that we made in December of 2019 about Eureka. One of the things I have heard consistently throughout 2019 is they would never attempt bail-in because there would be a revolution. Well, there has only ever been one attempt at an armed revolution against government in this country by citizens. That was 1854, and the citizens got wiped out in 20 minutes. So, and now we don't have the guns because of the Howard government gun buyback policy after Port Arthur. So the proposition that the governments or the central bank or APRA would not have the gumption to use these legal instruments or these legal tactics if required. I just think that's a fallacious argument. And so if they've done it in Cyprus, if they've done it in Melbourne in 1892, 1893, why wouldn't they do it in 2020, 2021?
Yeah, and the whole point about the global financial crisis showed us that in a crisis, they have to do things quickly, and they will do things that in the normal course of events you probably wouldn't think they would do.
Yes.
Right? So think crisis, don't think normal course of business.
Absolutely.
So, John, of course, then the real question now becomes, what is the relationship between the bail-in and deposit insurance?
That's a great question, Martin. So basically, we're just going to put an image on the screen that I published from my article where I talked about this issue of deposit insurance not being a guarantee in terms of bail-in risk. All of the major banks in particular have 3 layers of protection in order to ensure that they don't become bankrupt or insolvent. So they have their standard capital reserves. They have these hybrid securities that we just discussed previously that can be bailed in, and this is something that's openly acknowledged by the government. And we have, particularly for the big 16 banks in Australia, that have the committed liquidity facility. So it's basically the ability of, in terms of the banks, of giving things like mortgage-backed securities to the RBA in exchange for cash, and that cash can be used to basically prop up the banks in terms of its sort of cash reserves to allow it to become an ongoing concern. So if a bank or banks was to burn through these three layers of capital, and they are still in financial distress, then basically we have one of 3 options that are going to happen. Option 1 is that if it's in financial distress, it could get an external injection of capital, and that's called a bailout. Now, that external injection of capital could come from government, or it actually could come through, some sort of mechanism like a forced merger or takeover, and that is exactly what happened when JP Morgan Chase took over Bear Stearns in March of 2008. That was a forced takeover, at the behest of actually the government. The government actually encouraged that rather than allowing Bear Stearns to actually go into bankruptcy. So external injection of capital, bailout. That's option 1. Option 2 is that there is no injection of capital, and there's no new sources of funds for the bank, and at that point the bank fails. So now, if the bank fails, that is the necessary prerequisite to having the deposit insurance turned on. So what we need is a declaration of insolvency or bankruptcy by a bank. And then at that point, the government can elect to turn on the insurance or not. And if they turn on the insurance, then the government has to get the money from whatever form it can to pay the insurance out in terms of the deposit insurance. So that's option 2. Now, option 3 is that the bank can find sources of capital from within its own within its own book. And this is where bail-in comes in. So bail-in is basically the conversion of liabilities, like unsecured loans, which is what deposits are considered, into bank equity. And so rather than getting a capital injection from outside the bank, it can basically seize on deposits, converting that into shares, and that basically would give the bank sufficient capital to basically be able to be an ongoing concern and to continue to operate.
So, John, of those 3 options, right, what intrigues me is in what circumstances will it be option 1 versus option 2 or option 3? We really don't know, do we?
We don't know what option the banks and the government would take in terms of this. Now, there are certain circumstances where it may be politically expedient for the government to do a bailout. So if there is a bailout, that means that there is no need for deposit insurance and there is no bail-in. Now, under the deposit insurance scheme, they've got to come up with $20 billion per institution potentially to cover each institution. Now, if there are 2 or 3 banks that are in trouble, the government may say, well, we don't have 40 or 60 billion to pay the insurance, and they may say, well, we don't have hundreds of billions of dollars to bail out the banks. So in that circumstance, they may say, well, the most expedient option is to do bail-in, and so that's where bail-in may actually occur. So if they do bail-in, you don't have a declaration of insolvency or bankruptcy, therefore no deposit insurance. So this is why that deposit insurance is no guarantee around bail-in risk, because bail-in is to ensure that the deposit insurance is not paid by the government. But having said that, when a situation where a bank's in trouble arises, depending on what occurs. Now, if it's a small institution, the government may say, we're not going to bail out, we're just going to let it fail, and if we have to pay some deposit insurance, we'll cop that cost. There could be circumstances where they say, no, we'll actually bail out because that's how the politics of the day may run. Or it could be if the government has limited financial resources and they say we can't pay the deposit insurance and we can't bail out, well, that's when we need to do bail-in.
We're talking about lots of uncertainties here because we're not quite sure exactly whether it will be one bank, whether it will be part of a global financial crisis where multiple banks could be falling left, right and centre, right? So there's a continuum. If it's a single bank, then almost certainly the deposit scheme will be activated and it could well be no issue at all, right? But it gets more difficult as you get into a greater set of scenarios with multiple failures happening at the same time. In other words, if another GFC, right? And so if you're a depositor, recognise firstly that your deposits are unsecured loans to the banks.
Correct.
And by the way, you should be receiving a much higher interest rate than you are because as an unsecured credit to the bank, they should be paying you a lot more. That's just a sidebar, but a very important one. Secondly, the 250k limit is only activated at the government's behest, right? If it's not activated, then it doesn't exist.
Yes.
So all of the stickers that we see all around the place protected by the deposit insurance scheme is marketing spin, pretty much. It may well be activated by the government, but it's not there at the moment. So that means that people should be quite cautious about building a survival strategy around the deposit insurance scheme. And it also shows that there's a level of uncertainty around all of this, which perhaps people might find disturbing, but nevertheless, it's important to get their heads around it.
When I've had a lot of phone calls throughout 2019, the first question I ask people is, have you read your terms and conditions of your bank deposit account? And this is the key thing we're going to go into in part 3.
Yep.
But one of the other things that I have said is that you have to understand how bail-in risk interacts with deposit insurance, because having money under 250,000 may not be sufficient protection if bail-in was to occur. But also, don't assume that it's automatically going to happen, because there are other possibilities that are on the table, and you have to consider what those other possibilities are. So I think this discussion, people should reassess their, what the level of risk is per institution, but also in terms of the system as a whole. And obviously, people should make, a more informed decision about where to allocate capital. Now, the key point on this is that, so I think to sum up the conversation, it really comes down to, I think, politics and finances. So, the government of the day will make the most politically expedient decision possible. Now, bail-in will probably be the most, it'll be the less popular option to pursue. So there's perhaps a lower level of risk that bail-in would actually occur relative to paying the insurance or bailing out the banks. But if the government can't get the money to bail out the banks, because the government, since the end of the Howard government, the federal government has dramatically increased the amount of debt it has on the books of the Commonwealth government, but also the state governments have increased their in terms of their levels of debt. So there could be even some issues around the Commonwealth government having to come up with capital to bail out the state governments, particularly say Queensland, for example. So in that circumstance, if the government can't come up with the money, well, then I think the risk of bail-in actually occurs, and if it was to occur, even if you have money under 250,000, again, if they do bail in now, in Cyprus they bailed in at 100,000 euros and above. Although the initial proposition was they wanted to bail in right across all deposit accounts, but at a much a lower percentage in terms of conversion or confiscation of deposits, as opposed to the 47.5% that they did above 100,000 euros. So if the government has a limited ability to get the cash, the risk of bail-in actually does rise. And to know what would happen when the crisis actually comes, it's hard to forecast. So therefore, bail-in may happen, it may not happen, but the proposition that bail-in can never happen or has never happened in Australia, both propositions are false.
Yep, and as I say sometimes, John, expect the unexpected.
Absolutely.
Martin North, John Adams, in the interest of the people. We'll see you next time.